Hey everyone, Darrell here from the Wealthspire Investment Team for another installment of our Markets in 2 Minute series. We're going to take a step back and focus on the macroeconomy this month, and we've got an extra chart to discuss this go around, so let's get right into it. So by now, I think everyone is aware that the Fed implemented its second rate cut of the cycle back in September. And until recently, they were widely expected to implement an additional cut at the forthcoming December meeting. The market is still assigning a better than 50% chance of that happening, but things are starting to shift. Even looking further out in time at that yellow segment of the chart, you can see that expectations continue to be for interest rates to eventually come down another full percent or so. We think that looks a little bit overdone and that rates may actually settle in a little bit higher than that for a couple of reasons. The first is that the underlying growth trajectory in the economy is still quite strong and is also still seeing positive momentum. Here we're showing GDP forecasts from the Federal Reserve Bank of Atlanta, as well as a consensus figure shaded in blue. And these projections are based off of a variety of real-time economic inputs and have historically been relatively accurate in anticipating inflection points in GDP growth. And you can see here that there is an expectation for growth to accelerate as we move into 2026. And that's partly driven by the continued acceleration in AI CapEx spending, which has been a big component of GDP over the past 12 months. The other piece of the equation that is significant in our view is that there is far less leverage in the economy today than there was in previous cycles. Really, since the global financial crisis, there has been a significant shift of debt away from the private sector and towards the public sector. And it's the federal government now that possesses the less attractive balance sheet. So there's two implications here. One is that households, and corporations for that matter, are more resilient than they were previously. But the second implication is that on the margins, a weaker balance sheet for the federal government is likely to put upward pressure on rates going forward, as bond investors generally view higher debt levels as adding incremental risk that they then want to be compensated for in the form of higher yields. So it's going to be an interesting end to the year here with speculation on the Fed and then potential implications as we move into 2026 and all of those conflicting forces that we've discussed over the course of this year. But we'll keep tabs on all of this for you and report back as things evolve. In the meantime, we hope everyone has a wonderful Thanksgiving holiday. See you in December.